Now, whenever you're looking for hated stocks in very hated and distressed industries, you may find some pure value gems that have been left for the dead for no reason whatsoever, but just because people did not want to own them. But you could also run in a lot of value traps whenever you're doing in those things, as sometimes the market is right and you could be wrong. And a stock is trading cheap for a very good reason, not just because nobody wants to own them. And this is a stock that I've been kind of wanted to do a video on, as a lot of people asked me, and I believe Everything Money covered the stock. I'm not really sure, but somebody really popular on YouTube, I don't remember, but I've been asked about this stock a lot. And this stock is SWBI, Smith & Wesson Brands. It traded over $24 and now it's went down to $12. Now, if you look at the chart, it went up all the way up to around, I believe, $31 or $32 right after COVID. Why? Because whenever people got the stimulus checks and we had pretty kind of bad events, sadly in 2021, many people kind of went off and bought a lot of guns. And after that, you know, the revenues went up, everything was fine, and now the revenue is declining and the stock is going down. So in this video, we're gonna take a look and see if it's really justified right now, or if it's maybe still a value trap and we should wait a little bit more. Because I've been looking at this stock since it was around $15 or $16. People asked me about it, and I looked into it and I actually figured out that it was a value trap. So I'm gonna let you know why it was a value trap and if it still remains the same way, or if something actually changed. All right, now the way I found about this stock from the beginning is from the magic formula screening. Sometimes I like to look at those stocks. I don't believe in this kind of system of buying, you know, the cheapest stocks on the list, and SWBI was on this list. And now it got even cheaper, but for some reason the stock got removed and it's not on the list anymore, which is again show you that some of these things don't actually work. The same thing with GoPro. Now let's look a little bit at SWBI. If you look at the PE ratio, it's sitting around 5 times earnings. Now whenever you hear of 5 times earnings, you say, oh, the stock is cheap, I'm just gonna go and buy it. Well, maybe there's a reason why it's cheap. All right, now 5 times earnings is pretty cheap regardless. But this is where kind of things starts to play out. Now, if you look at the revenue of the latest earnings report, the revenues were down 69%. I'm not making this up, 69%. Why? Because this industry is cyclical. And this is the problem with the whole stock. Now, if you look at, you know, on a historical basis, you could see it goes up and it goes down, it goes up and it goes down. And, you know, sadly to say, but whenever you buy a stock like SWBI, the best time to buy it is, of course, whenever, you know, everything is fine, everything is calm and there's nothing happening. But because the main reason the stock is gonna go up is if you actually, you know, a bad event happened, like what we had in, you know, 2001, like what we had in 2021, like these type of events tend to happen. This is when, you know, people go and buy guns, and this is, you know, the sales go up, everything is fine, and then it goes back down. But the company has changed a little bit, but this is the nature of this business, and this is one of the reasons why the revenue declined 69%. All right, now this is where the whole kind of value trap is, and I'm gonna show you why. Whenever I looked at the stock, I saw 110 million of cash, you know, 326 million in current assets, and they have zero long-term debt, which is something smart that Smith & Wesson did. Whenever the stock went up and, you know, everything was fine with terms of revenue were growing, they took all the free cash flow and they paid down the entire debt, and they actually bought back some shares. So now they have zero long-term debt, which is pretty amazing. So I looked and I said, oh, 326 million of current assets, total liability is only 161 million. You know, the equity, the stockholders' equity is around 360 million. If you take some goodwill out and stuff, it could be sitting pretty close to 300 million. And the stock back then was like 700 million. So I said, you know what, this is really not bad at all. And it would give me some kind of margin of safety. But this is where the big problem is. Now, Smith & Wesson brand, the state where they are located right now, I believe it's in Massachusetts. They really want them to move. The state over there, they don't want gun manufacturers in the state. So what happened is they're going to have to relocate to Tennessee. And you may say, all right, I mean, this could happen. This is nothing bad. But no, this move is going to cost them 120 million. And it will be funded by the cash on hand. So all of a sudden, this amazing cash balance of 110 million and zero debt is going to be zero. So, it's not much of a margin of safety. Whenever I buy those kind of, stocks, even like, for example, Core Civic or GEO, if the assets that they own are 2 to 3 times, for example, whatever the debt and whatever the market cap is, this would give me some kind of margin of safety, all right? But with Smith & Wesson brands, you had the 110 million of cash, and it looks pretty amazing. But if you take in the 120 million, that's gonna cost them to move, and all the other moving costs and hiring new employees, maybe at higher wages, because whenever you hire new employees now, most of them, they get paid more than the old employees because of inflation and many other things. So it's gonna be very costly for them, and it's gonna wipe out the cash balance, therefore wiping out some margin of safety. And this is the reason why I haven't bought the stock around $16. But the stock is sitting now at $12, pretty close to 52-week low. So we're gonna take a look a little bit more. And again, Smith & Wesson brands, they did something amazing. They have been buying back stock, which is something great. And they also have a dividend. I'm not sure how big the dividend is. I believe it's around 4 or 4.5%. No, it's actually 3% dividend, which is, again, not bad. Now, this is where the big problem is in valuing something like Smith & Wesson, because you could try to do a DCF or whatever, and this is a big mistake most investors make. Every single stock, commodity stock, value stock, growth stock, they just put a DCF. Well, it's not so easy. Every single stock has to be kind of valued in a different way from the other. Some stocks, you value them on, breakup value, some stocks DCF, some stocks more on net income, some stocks on a relative value to another type of stock. And this is just the way it is. Now, it's pretty hard, in my opinion, to value Smith & Wesson brands, mainly because of the cyclical nature of the business. The free cash flow goes up and then it goes down. But again, something good to know that, pretty much every single year since 2011, SWBI has at least generated some free cash flow, which is, again, not bad at all. And the current market cap is around 531 million. Now, if you actually just take a quick look at the, free cash flows that was before on average, they made, 23 million, 43 million, 88 million, 36, 56, 24. So in my opinion, the average free cash flow of all those years is around 40 to 45 million a year. And I believe you guys can agree. And again, you could see, well, if something happened like in 2021 or something like in 2016 or something like, in other years, a pretty bad event, sad to say, then they're going to make a lot of revenue. But this is not something you can bet on whenever you're buying Smith & Wesson, because if nothing happens for 5 years, then what are you owning? So again, in my opinion, around 40 million of free cash flow going forward is really not bad at all. Now, the company, I believe they guided 75 million of free cash flow for 2020, for fiscal year of 2023, which is, again, not bad. And we could take, the 40 million, and we could time it by 4, that's 160 million, and then we can add in the 75 million that the company said. Now this is around 235 million. And if we take just the cash balance, we don't count it because it's going to go to open the new facility and stuff. Now that's 235 million. The company is around 531 million. So that would generate around 40% of the entire market cap back in cash over the next 5 years. Now that's pretty amazing, especially if they also use it to buy back stock and other things. But in my opinion, it's not cheap enough to own. And especially if they do get around 40 million or even, let's say, 50 million of free cash flow, that's still trading 10 times free cash flow. 10 times free cash flow for such a business is very expensive in my opinion. You could buy plenty of other stocks with much more kind of predictability for those revenues for 10 times free cash flow or less, even maximum 12 to 13 times free cash flow. But again, if we take in an average free cash flow between 40 to 50 million, Smith & Wesson brands would be trading right now between 10 to 12 times free cash flow. And in my opinion, with the whole nature of the business, it's not cheap enough for me to buy it again. And now if the company generated, for example, the entire market cap in free cash flow over the next 5 years, that would be something interesting. And they may actually do it if they have another 2021. but this is not something you have to bet on whenever you're buying Smith & Wesson brands, and they don't have kind of any valuable real estate that's undervalued like CoreCivic or GEO or many of those others kind of hated type of stocks that they actually have. So you're really not having much margin of safety if you're buying Smith & Wesson, right now. And again, the stock is sitting now around $12 per share. It's clearly close to a 52-week low. Now, in my opinion, a Smith & Wesson brands would be a buy around the $400 to $300 million market cap. At least, if they do use, the whole, kind of cash position, you would end up with around, I believe, 250 million of shareholders' equity, which is, again, the stock would be trading 350 million. So you would have something in your hand as kind of a margin of safety, at least some type of margin of safety if you're buying Smith & Wesson. So for me, personally, I'm interested in the stock, but it's not cheap enough yet for me. For me, the stock is a buy under $10 per share. Why? Mainly because of those things I showed you, and now as the market is going down, I can get pretty amazing opportunities and much actually cheaper than Smith & Wesson brands. So therefore, for me, it's not a buy right now. I mean, under $10, it would be much better buy, and then maybe dollar cost average down. I mean, the stock went as low as, I believe, $4 per share. Now, I'm not saying it's gonna go there because now it's paid off some debt, but it could go to $8 per share or $9 per share. I would not be surprised at all. So this is my analysis on Smith & Wesson brands. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.